Hello folks, in this video I will explain the characteristics of tradable order blocks. But before I start the video, I will plead to all my viewers that kindly like and subscribe the channel. That will not only help the channel to grow, but it will fuel me enough to come with extra content that will help all the traders. So let's get started. So I hope you all know what is an order block. And if any one of you are having any sort of confusion, then kindly go to the previous videos where I have explained order block in detail. I will also share the link in description. So for today, we will discuss the characteristics of tradable order blocks, and that will be more likely to hold the market for further moving up or for further moving down, which will make your prediction flabbergastingly correct. So let's get started. The block should be near support or resistance. Let me repeat again. The order block should be near support or resistance. So the first characteristic is saying that the order block should be near support or resistance, let's say. And this one was the order block which is near the previous support, or let's say this one is also a support. So it was an order block which we can see we should have took the entry at this point, mitigating the order block, and we would have set our stop loss below the support, and our take profit area would be the next order block. So these sort of trades are somehow 1:3 risk to reward, as we can also see on the chart. So that was for the example of order block near support. Now let me show you example of order block near resistance, which is stated in the first characteristic. We can see this is an order block which is near the resistance area at this point. So how we would have set our stop loss? We would have set the stop loss above the resistance area, and we would have targeted the next order block which is at this area. So it was also 1:3 risk to reward trade for us, only if we could have traded it. And we can see how the market moved to the downside after mitigating the order block near the resistance area, and we can see how the market moved to the upside after mitigating the order block near the support area. So this was the first characteristic. Now let's move toward the second one. Order blocks should be near or at flip zones. I have also explained the flip zones in my previous videos in my support and resistance video, and I will again describe what is a flip zone. A flip zone is an area where a previous support becomes resistance, or where a previous resistance becomes support. So here it is another pair which is USD CAD, and I'm showing you the example of second characteristics of tradable order blocks. So as we can see, this was a previous support area which turned into resistance, which is a flip zone. Support became resistance, and here we can see this one is the order block which is at near the flip zone, so the market approached this area We can see. Let me minimize it later. So what happened? The market approached this zone, this flip zone, and this order block which is near the flip zone. The market touched this area, touched this order block. What we would have done at this area, we would have placed our stop loss above the resistance, the main resistance, the main key area. The next order block should be our target. We can see this area was a support, or let's say this area was a resistance which later became support. And we can observe the order block near the flip zone. So the market just approached the order block, mitigated it, and moved to the upside. We would have set our stop loss below the order block at this point, or we would have set below the key low. And for us, the next order block would have been our target, which is this area. So again, it was an easy 1:2, 1:3 risk to reward trade for us. Okay, so it is stating that the order block must break the market structure, which we call BMS, breaking market structure. So what does that mean? Breaking market structure. What does BMS mean? It means that the order block break the market structure, break the support or resistance area. If the order block is a bullish order block, it will break the resistance to the upside, or if the order block is a bearish order block, it will break the market structure to the downside, as it means it will break the previous support. So let's say this area. So the bullish order block is defined as the last bearish candlestick before the up move is known as bullish order block, and which break the market structure to the upside. So this was an order block. How it was an order block? Because this area was a resistance, was a market structure, was a short-term high. So once the bullish order block formed, it broke the market structure to the upside. You can see. And once the market approached this zone, this order block, so it is obvious what happened. This is how the market moved and turned to the upside. So what we would have done at this point, we would have set our stop loss below this order block, and we would have targeted the next order block as our profit target. Let's say this area. And let me filter it out, let me repeat it. This one was not an order block, as it didn't break the market structure to the downside. So we would have targeted the upper resistance point, which is this one. So here we can see the market would have easily given to us a 1:5 risk to reward trade at this point. So that was the example of bullish order block. Now let me show you example of bearish order block. The characteristic of tradable bearish order block. So as they say, the tradable order block must break the market structure to the downside. And we saw what does that mean by breaking the market structure. Like here it is a short-term low created by the market, and this order block after its formation broke this low to the downside. So now this order block satisfies the criteria, and it fulfills the criteria of a tradable order block. So what is a bearish order block? It is defined as the last bullish candlestick before the down move which break the market structure to the downside is known as the bearish order block, which is this one, the last bullish candlestick. And we saw what happened. The market approached the order block, and this is how the market turned completely to the downside. Amazing. So here the market would have given us a 1:8 trade, 1:8 risk to reward trade. Like we would have set our stop loss below the high, below the key high, and we would have targeted, let's say, the next order block. So the next order block could be this one, and it could be this one at this point. Now let's move toward the fourth characteristic of tradable order blocks. The fourth characteristic is stating that the order block must take out an opposing order block. Let me show you what does this point mean. So here I found a better example. This one at this point, this is an order block, and how it fulfilled the criteria. It fulfilled the criteria in this way that this order block is near the flip zone where the previous resistance became support. Let me straighten it down. Yes, this way. So again, and it is also, that was the first point of fulfilling the criteria. The second point is that this order block broke the structure to the upside. It broke this resistance, this short-term resistance. So this one is a valid order block. So what happened? This one is a bullish order block, and here we are having a bullish bearish order block, the below. So what happened? This one is a bullish order block, and the one above is bearish order block. So what happened? Once the market mitigated this order block, market moved to the upside, and it is taking out the opposing order block, which is the bullish order block. So it means that we will look for bullish order block in a bullish trend, and we will look for bearish order blocks in a bearish trend, and that is the characteristics of tradable order blocks. The fifth characteristics of tradable order blocks is bearish order block must be above buy stop liquidity, must be above BSL. BSL is known as buy stop liquidity. So what is a buy stop liquidity? Buy stop liquidity is the are the stop losses that are resting above the resistance area, or the liquidity that is resting above the resistance area is known as buy stop liquidity. So let's say at this point, this is an previous resistance area, short-term resistance area, and above this short-term resistance area there is resting an order block near the flip zone 2. It is near the flip zone 2. So what happened? The market took the liquidity from this high, from this short-term high, and it also mitigated the order block. So what we would have done, we would have placed our stop loss few pips, let's say 5 to 6 pips above the order block, and we would have targeted the next order block is our profit target area. Let's look out to another example. These are relative equal highs, and most usually the liquidity is resting above relative equal highs, which we will call as buy stop liquidity. And when there is an order block above that uh, relative equal highs or above that high, the chances are the market will just approach this area, just mitigate the order block, and it will turn to the downside. Let me show you. Here we were having an order block, which is the green one. So what the market did, it went above these relative equal highs, mitigated the order block, and turned completely to the downside. So we would have placed our stop loss above this high, and we would have targeted, let's say, this order block, or let's say we would have targeted this area, this order block. Now let me show you what the sixth point is saying. It states that the bullish order block must be below the SSL. What is the SSL? SSL is the sell stop liquidity. The sell stop liquidity is mostly resting below the support area or below the relative equal lows. So here I found a better example in the gold pair. These are relative equal lows, and what is resting below the relative equal lows is SSN, which is sell stop liquidity. And what we are having below these lows, we are having this bullish order block below these lows, or let's say, let's make it this one, this small order block, the red one. So what happened? The market not only took the liquidity, not only hunted the stop losses from these relative equal lows, it also mitigated this order block. And the market, after mitigating this order block, went to the upside. So here we would have placed our stop loss below these, let's say, a short term low or an intermediate term low, and we would have targeted the next order block is a profit taking area, let's say this one. So it was clearly 1:3 risk to reward rate for us. So this is how we will be trading the order blocks and master these characteristics of order blocks for better results. See you guys in another video with another topic. Take care.